All right, Dan, thank you so much for joining to chat with me. I got to tell you, I've been super excited about this conversation for the last week or so since we decided to do it.
Likewise, for sure. Thank you for having me.
Well, maybe let's start first, like give people the intro on you, the sort of 30 seconds specifically on your role and the kind of purview that you have in the world. I think you have a really unique perspective, and so I'd love to let people understand kind of where your context is coming from.
Sure, yeah, it's goes back a ways. So I've been like in and around startups for about 20 years. That includes in startups, in accelerators, in venture builders, working with VCs in proximity to, but never at a VC, and then ultimately landing in Equidam a few years ago, where we focus on startup valuation, which is kind of like an eccentric part of the ecosystem. And through there, living through like the 2022 crash, sudden great interest in valuation, a lot of interesting conversations with VCs, learning about how that works. It's been a really interesting and unusual entry point to all of this, I think.
Yeah. I feel like your perspective has like awoken threads in my thinking that are very logical. They're very logically adjacent to other stuff that I think about, but that I hadn't stopped to consider. And one of the things I wanted to start with, because of the perspective you have at Equidam, is I remember this. I think it was like early 2022. Matt Turk at FirstMark tweeted and said, "I'm a professional early stage venture capitalist, and I do not know what the right valuation is for a seed or Series A stage company." And I feel like anybody who has been investing over the last 5-6 years feels like they've been through the prior 30 years, because like the cycles were much longer, and now it's like 2020 was crazy as things dropped out. Then 2021 was insane. Then 2022 things dropped out again. And then AI kind of reared its head. And now you have this like really bifurcated world of the haves and the have-nots and startups. And so what that level of volatility across the market, I feel like makes the most complicated is to have any real understanding of how to value a company at any given stage, especially when you have these companies that are seeing, they go to from 2 to 55 million of ARR in 4 months. But then you have some of them that like from 55 drop back down to 8 or whatever. Like the volatility in the companies is more aggressive and the pricing is more aggressive. So maybe as a starting point, how do you think about startups and that sort of price volatility?
Great question. I mean, I think it's helpful with something like this to maybe look at the extreme case. So if you imagine like the best performing VC you could imagine, it's probably someone who's invested in a company that nobody else believes in, and it has like immense potential, huge multiple time fund return or whatever. But how do you understand the value of that from day one if there's nothing else like it in the world? You have to kind of take a first principles approach of you learn about the company as much as you can. You look at it from every possible perspective. So that includes even like controversial things like maybe a DCF on like the future forecasted financials.
That's a word that most people in venture, I don't think, even know what that means.
Yeah, that's true. Yeah, discounted cash flow. Look it up. It's a useful one.
Yeah, it's gonna be.
But yeah, you learn about all these perspectives on the company, and you have to kind of like piece it together yourself. Like, what money am I putting in? What is it likely to look at when it comes back to me? Does it make sense financially? Like, kind of operating in a vacuum. Because VC has become such a relationship business, such a like comparative pricing business. I think a lot of people have forgotten that like first principles perspective of like, if I'm the only person in the world who believes in this company, what's it going to look like and how do I figure this out? You need to be able to do that, I think.
You had a, I think this was a post of yours where you talked about like revenue multiples used to be a way of like, it was just after the fact, after you had done the actual analysis to determine a price, you would then use revenue multiples to be able to compare apples to apples. Today, revenue multiples are often the way that we arrive. Like you say, like, oh, well, that company got, a 75x revenue multiple or ARR multiple. And so if you apply that to this, that's comparable, done, that's the price. Like, tell me a little bit more about that, what you thought of when you kind of looked at that and how you think about the current market of like just slapping a multiple on it and saying, yeah, that's pretty good.
Yeah. I mean, if you look at how multiples are used in public markets, you would say, look at like, what's the revenue multiple for Rivian versus Tesla? And you would say, okay, Tesla has a much higher multiple, therefore the market thinks Tesla has much greater future potential. That's implied by the multiple. The multiple is calculated based on the price that it's been given in the market. Like, it is not priced with the multiple is an output. the same thing should be true for private companies too. And it, I would say it originally was. If you go back and you read old blog posts by Bill Gurley or on the Andreessen Horowitz blog, they talk about this. They talk about multiples as an output evaluation to compare companies after the fact. So it's not even like I have a particularly insightful or unusual perspective on this. It's more like I have an old-fashioned one, I guess.
Right. Yeah, totally.
But if you try and do a valuation based on a multiple for an early stage company, then you start talking about things like, how do you calculate a run rate? Do you use the last 3 months? Do you use the last 6 months? Last single month? It becomes this weird abstraction of trying to find meaning in volatile, fluctuating revenue, which I think is kind of silly.
Yeah, I also, to your point, this sort of framework, it's not that it's magic or super unique or anything. It's just that it's not the way that the game is played today. And I feel like that's indicative of everything. Because I agree, yes, in a vacuum, if you could make this decision and just say, there are no investors in the world, there are no other companies in the world, just I as an investor, do I believe that this company represents a good financial opportunity, upside, what can they grow to and return to me and stuff like that. But at the end of the day, I feel like there are two approaches that most investors take when thinking about how to value a company. And often it's either or, where either you're just focused on how do I win this deal? What is the clearing price? And I actually don't care what the revenue is. I don't care what the long-term potential is. I think that the clearing price to win this deal is X. Therefore, my inputs to my model, if I have one, are whatever yields X, because I need to justify X. And you say, oh, well, even if this thing has to be the fastest growing company in history, it will do it because I need it to, because I need X to be the price to win this deal. That's a huge swath of how investors think about pricing anything. The second bucket may be that some people consider, and they might consider it in tandem with how do I win, but they're trying to think about ownership targets. And they're saying, well, I need to own X of this because, over time I'm going to get diluted and I need this to be certain size outcome. And as I'm considering portfolio construction, right? I think we'll get more into how portfolio construction has kind of gone, the way of the dinosaur in general. A lot of people are not considering it at all. But I feel like there is still a good number of people who are thinking about, for my portfolio to make sense, I need to own X% of a certain number of companies that I think could return the fund or whatever. So that's the game on the field. Now the question is okay, does that mean, I keep thinking about in public markets, people talk about efficient market theory, and I can't remember if this is a Buffett quote or something else or somebody else, but this idea of a lot of people think that what you're trying to do in the public markets is predict what a stock price is going to do. What you're actually trying to predict is what everybody else is predicting the stock price is going to do. You're one layer removed from rationality because you're trying to almost irrationally forecast what other people's irrationality is going to do to the stock price, or what they think the stock price is going to do. And it feels like we've gotten there in venture too, where the price doesn't actually mean anything. It's just a clearing price. Do you think that's true, or do you think that people are more sophisticated than that?
Yeah, I mean, that's something that Aswath Damodaran has written about, the Dean of Wall Street, Dean of Valuation for Wall Street, NYU Stern professor. He talks about how venture capital has become an industry of traders rather than investors. And they're looking more at short-term transactions rather than long-term accruing of value.
And also some VCs are relentless self-promoters. They try to promote themselves as people who can judge businesses, amazing gaugers of whether a business will pay off. I've never believed that about VCs. I think many successful VCs share more with successful traders than they would successful investors. They play the pricing game. Now, what does that mean? They get judged on timing, when they enter and when they exit, gauges of mood and momentum.
So I think you're right, but I think it's also a bad thing for the industry that it's gone that direction.
So maybe that's a good play. I think the thing that you and I bond over a lot online is the sins of this industry. And so, maybe let's think about the whatever it is, our 5 or 7 deadly sins of venture. So in my mind, I think that does really get that idea of traders versus investors. In one of my pieces, I kind of ragged on venture as largely have become an industry of pansy ass allocators, where it's their primary focus is on using pretend LP money to be as aggressive, as big, take up as much room as possible with very little thought given to investing. Whereas I read, these stories of the history of venture, and it's the one that I quoted in the piece that I wrote was, I think it was Atari, where Don Valentine met the company and he was like, hey, it's too chaotic for me to invest right now. But what I'm going to do is I'm going to roll up my sleeves and I'm going to help introduce them to these people and help do this and that. And so even before he's an investor, he's saying, I can see the value in this thing. It remains to be unlocked, but I think that it could be unlocked and I can be a meaningful part of helping unlock that. And then there's an opportunity to invest once you've kind of de-risked some of those things. You don't have that at all. Like on average, I think the typical investor will spend 2 to 3 weeks really deeply thinking about a company. And then they'll spend a couple of hours once a quarter at a board meeting, right? Like it's like very rarely are you spending extended periods of time over the course of years really thinking deeply about a company because you are focused on like this transactional, this trade, this thrill of the hunt, whatever. So I feel like that in my mind is like one of the worst things and it causes a lot of other problems. But that systemic cultural shift from are we helping build companies or are we like picking ponies is like a really problematic thing. I don't know if you would agree with that being a core sin.
Yeah, I would definitely agree with that. I would also wonder how many people in the venture industry today have the potential to have the kind of impact that Don Valentine did. Their asset class has expanded so much in terms of headcount, and the people involved in investment today, you know, they come from a variety of backgrounds maybe, but I just don't think it's a value add game anymore. Like the quote about platform teams, they weren't created to create value for founders. They were created to manage a large portfolio of investments for the GP. Like it's the other way around. It doesn't really work like that anymore. It's too big.
Do you think that is a function of, so like the platformization of venture funds, is that exclusively a function of GP support and like extension of capability? Is it marketing? Is it justifying why you should raise such a big fund because you need big fees, because you need to pay for a big team? Like, what do you think is I have my thoughts, but I'm curious what you think of the primary motivators of this bigger and better platformization.
Yeah, I think that this is kind of almost like maybe one of my 7 deadly sins of venture. It ties into that quite nicely, which is you've had this, and we've both written about this topic, like the rise of you call them the agglomerators, I call them the venture banks. They're like A16Zs and Thrives and General Catalysts. There has been, as they've like grown and kind of dominated the venture ecosystem over the last few years, the practices and habits that they have spread through the industry and been copied and emulated, including things like platform teams and you know, trying to create value for founders and so on. But that doesn't actually translate to the traditional venture model particularly well, like as a scaled service. And it's that confusion between the two that's created a lot of the headaches, I think, in the last few years. People who are running a $150 million fund, but trying to act like A16Z. Like, it doesn't add up. It doesn't work. You take way too much risk. You know, you're not properly servicing founders in the same way. It just it doesn't work.
I have called that the loudest models. I've written about it a few times. I talked to Trace Cohn about it a couple weeks ago. This idea of like, yeah, because I think one of the things that I have hesitated to like call total bullshit on is that it's necessarily bad. Like that having a big fund, raising multi-billion-dollar funds, like I think that there is a world where that represents a product that is valuable for a very specific type of LP, where if I'm managing hundreds of billions of dollars as an LP and I need to deploy $200-300 million of pop, I can't put that in a $250 million fund. Like, I'm not going to be their whole fund. And so having a multi-billion-dollar fund gives me exposure, and I actually don't care about typical venture style returns. I don't care about 3-5x net of fees, right? Like, I care about like a 6% yield. Like, all I need is a replacement cost for my pension or whatever. And so like that's that, yeah, like that I could see a world where that's an ecosystem. And by the same token, like I talked about this in the unholy trinity of venture capital, of like the third prong is these capital absorbers is what I called them, right? Like, there are some companies that are like crazy capital intensive, and like there's a benefit strategically. We can talk about that too, because the venture predation thing I think is a really valuable conversation. But let's just say, like, the benefit of the doubt is that model can work. The danger is that everybody looks at that and says, oh, hell yeah, that's the game I want to play. Like, I want to have the biggest fund, or if I'm an LP, I want to be deploying into the sexiest things, or if I'm a company, I want to be burning ungodly amounts of money in pursuit of exceptional growth. The reality is, I feel like the majority of participants in the company building ecosystem not only shouldn't, but like can't fit that model. Like, they're just structurally they can't do it, but they're going to, and they're going to destroy a lot of value in the in the interim by pursuing the loudest models.
Yeah, I think that's very well said. And I think I would even go a step further and give Mark Andreessen and Ben Horowitz more, like a lot more credit than I would have given them a few years ago when I was still trying to understand all this. You know, you can look at venture capital in general. There's a famous quote by Bill Gurley about this, about how it's set up to be boom and bust, this like sawtooth pattern.
I think it's inherently cyclical, and it's always going to be that way unless we fundamentally change the structure of the industry. But I went and talked to some LPs that have been in the business for a very long period of time. And a vast majority of the reason venture outperforms other asset classes has to do with these tiny windows when you have a super frothing market. And if you aren't around for that part, you know, if you strip those years out of a 40-year assessment, it's actually not that interesting an asset class.
And you look at past cycles and you see every time there's a crash, a ton of firms wash out, the market is in drags for ages. It's terrible. It's my opinion that A16Z looked at that and said, we want to build something that can survive through these cycles, you know, relatively unscathed compared to the rest of the industry. And that's basically what you've done, or what they've done. You can see that in the fundraising data from the last couple of years. They raised a huge amount of money last year, despite the downturn. And it seems by all accounts like A16Z, their portfolio companies, much of their staff, they will ride through this cycle unharmed, whereas there's been huge churn elsewhere. I think that is like underestimated and massively to their credit that they've innovated to that kind of extent.
So let's talk about the venture predation stuff. So like a super interesting framework of, I feel like it's something that like, it's one of those like, yeah, we've kind of all talked about this, but like somebody put a term and a structure to it and it like articulated something that we'd kind of all thought about, where it's this idea of like, you know, people always talked about, oh, there are what should be commoditized services like ride sharing that are heavily subsidized by venture funds. So they can have negative unit economics for a long time and offer a service in order to be able to grow, achieve scale, completely disrupt industries, beat out competitors, whatever. And then there's kind of two pieces of it at the company level. And I've written about this with Uber as the example of like, it's like, yeah, you kind of can like bleed dry, not just like your competitors, but the entire industry, right? It's the entire paradigm around taxis or private cars or whatever. Like you can just suck up so much energy. And then you have stuff like Dara, you know, a year or two ago saying, hey, you know, before we really go big, now is the time to stop and make sure our unit economics work. And it's like, dude, you're doing like billions and billions of tens of billions of dollars in revenue. Like now is the time to stop and make sure the unit economics work. Like that wouldn't have been possible if it wasn't for massive subsidies from venture. But then the other side of the coin is on the venture side. I have said multiple times that investors increasingly, they don't care about ultimate outcomes. They care about incidental outcomes So a good example of this is Peloton, where John Foley, who's the CEO of Peloton, kind of rode that into a massive upswing, you know, hugely unsustainable, like total ZERP COVID era benefactor, did not sort of batten down the hatches when they should have in that situation. But there are a ton of investors who made a ton of money by selling into that run up. And then, yeah, the company's ultimate outcome is not a great one. But when John Foley goes to raise money for, I think it's like a luxury D2C rug company, and you're like, what? Like, what are we doing? But it's like a ton of his Peloton investors line up to give him, I think he raised like a $20 million Series A right out of the gate, because it's like, listen, this dude has made us billions of dollars. I don't care if the company ultimately was unsuccessful. I care about that, my incidental outcome, and I made a ton of money. Therefore, I'm going to let this guy have another swing at it. So both the venture funds and the companies, I think they leverage this model of big to be able to get their incidental outcomes, whether or not that's ultimately the best thing for innovation, the ecosystem, whatever, remains to be seen. But I'm curious your take on that. Like, why is that bad? Why is that dangerous? Should it be different? Is it even possible to be different in a world where there's so much capital?
Yeah, I think the paper you're talking about is super interesting. It uses the case study of Uber, which is, I think, is like the most obvious as well, like the highest profile, Uber versus Lyft. But actually, I think that maybe isn't like the worst example of predation. In a sense, like creating the ride-sharing industry as we have it today, like perhaps that was kind of necessary, like kind of a part of like the boom and bust that needed to happen to make that work. What I have a bigger problem with is looking at like the amount of capital that went into like B2B SaaS and what that did to SaaS company margins or even just how they thought about like financial discipline and financial health. So now you have 600 plus companies who are like of a unicorn scale that can't exit because they have poor financial health. And it's essentially because they grew up in this zero-sum game of predation. Everybody was eating each other's margins, and now the capital's gone and they're all kind of like left stranded a little bit.
Yeah. So I think that, this idea of like zombie unicorns or whatever. Yeah, I think this is the argument of that the problem is that we try and point to the sins of these big examples, right? Of like Uber. And it's like, well, Uber worked. Like Uber is a dramatically larger business than Lyft. And a ton of the competitors have died. And what's more, I think even 2-3 years ago, people were criticizing because Uber had yet to generate any free cash flow. But now they're like printing free cash flow. So like Uber is a good, successful business that has done very well, and then that allows them to extend into other areas of interesting capability. Where like Lime, as the scooter business. Probably, as Bird is kind of an example, really difficult to survive on your own. But as a adjacency to an existing massive rideshare business, that's actually pretty solid. Like that's a really good fit for them. They can do a lot of things. Amazon, same thing. Like Amazon's really successful. AWS exists because of Amazon's scale. That's really powerful. Starlink exists because of SpaceX scale. That's really powerful. Like there are these adjacencies that let these big winners succeed. And so that's why I feel like I can't say this like big firms funding big money hungry companies raising massive dollars from huge LPs. It's hard for me to say that's bad. I think the negative fallout of that is what you're describing, which is like the ocean of Walking Dead unicorns who tried that model when like you should have been able to point and say just rationally, like it's very unlikely that there can be a good outcome in most of those situations.
Yeah, I think that's the main difference. You could look at Uber and you could say, if this thing works, it's going to be monumental. But for the 600 B2B SaaS companies, like they did not have a path to an exit on that scale. Therefore, those investors should always have had an eye on, what's a reasonable exit timeline? What kind of metrics do we need to hit to get a good exit on that kind of timeline? To expect something like an Uber outcome to be that common across the industry, like clearly was not reasonable. But there's another little point you made I want to touch on as well. The incremental outcomes, the slowdown of IPOs, the rise in activity on secondary markets, particularly for OpenAI, Anduril, all those kind of huge brand startups. I get the feeling like this is creating a second category of VC investments and VC returns, which is like constantly tapping into secondaries, as opposed to the old model of like you hold for 10 years or whatever, and then you hope for an IPO or an acquisition. I just wondered, do you have any thoughts on that? Do you have any thoughts on whether that trend is like a fundamental change, or is it a temporary change because of the downturn?
The logic that I have been hearing for years is that, and even I saw this a couple of weeks ago, it was like the CEO of Goldman Sachs was saying, yeah, there's just really not much of a reason for companies to go public anymore, which is crazy from the guy who like makes his paycheck based on taking those companies public. Even that guy is like, I guess we don't make sense a ton, like that's a huge change, like that, even more so than like, because I was always like, oh, like Stripe, like somebody, Buco Capital is one of my favorite people to follow on Twitter, and I think he made the point where he was like, I just want to stop and think about the fact that we've gone through like 3 boom and busts and Stripe has still not gone public. But like if you're those companies, there is a huge added burden of being a publicly traded company. Like from a compliance perspective, the types of things you can do, the types of litigation and regulation that you open yourself up to. And so being public has a lot of drawbacks. And the biggest reason you do it is to get access to liquidity markets. Secondary markets become even remotely efficient enough to provide a sizable amount of liquidity, then like all of a sudden the biggest reason you go public now has gone away, and so it's even more enticing for the Databricks and SpaceX and OpenAIs and stuff of the world to not go public. And you'll see that too with stuff like Thrive putting $1 billion into Databricks or whatever. So it's like it's not even just like the secondary markets. I think sometimes people think about like, oh, these sort of casual, your buddy gets a bonus and he wants to put 10, 15 grand into Databricks stock or whatever. This is like, large institutional investors who want access to a business that probably they would just buy on the open market, but now they're going to go in through these vehicles. Like all of that volume creates that that benefit. And one of the things that I think is the most dangerous about that, because selfishly, I love when companies go public. Number one, because I get access to them just as a retail investor. But number two, because it does, like, it forces those companies to operate in public. Like, I can learn so much more about a public company than I can about a private company. And like we, at Contrary, we run Contrary Research, which is, one of the largest databases of private markets research out there. And we can get a lot of context and perspective, but there is always at the end of the day, a lack of transparency into the underlying business. And selfishly, just as like a student of businesses, that bums me out because I want to, like, I would love to, drill into, the 10K for SpaceX and read about, how Starlink is doing and how they think about coverage or whatever, like whatever interesting information I can glean. I love that stuff. So selfishly, it's like, I wish that existed. But more on a more macro level, I'm concerned about the reality of how easy it is to hide a multitude of sins as a private company. And the best, most egregious example of that is WeWork, right? So it's like WeWork effectively didn't do anything illegal. Like, they didn't break any laws. They didn't get brought down by fraud. They didn't get brought down by controversy or whatever. It was literally, they were just like, look at our business. And everybody was like, oh my gosh, like, that's awful. And everything just tanked, right? And to this day, it's not come back. It probably won't come back. Like, it just $47 billion wiped out, right? And not to say that, like, I think that, like, a huge variety of later stage companies are WeWorks, like they're houses of cards or whatever. But like the lack, and it goes back to this idea of like a clearing price, right? And investors being traders, is that the majority of investors are not doing enough work to understand these companies to be able to say, hey, this is bad, this is good, this is whatever. And so there's a ton of things that can get sort of swept under the rug because it doesn't have that light of day, like, I don't know, like the disinfectant or whatever.
Yeah, and that's kind of why you get the problem with adverse selection with secondary markets, which is like my biggest concern, given the lack of transparency in venture and the resistance to transparency in venture, is how do you have a healthy secondary market that isn't plagued with adverse selection? Because what you have today, you have the top 30 companies, it's like the setter 30, the ones who have the most requests on the secondary market. And they're all like household names. Everybody knows them. Like Anduril, everybody wants shares in Anduril. SpaceX, everybody wants SpaceX. And people are willing to pay rational prices. They're willing to pay without knowing any of the underlying information that they would typically have access to because the brand has so much pull. But you go down to like place 50 or place 100, how soon does that drop off and suddenly like you're only able to sell at like a 20% or a 50% discount as a company? That's kind of what worries me, is we end up leaving secondary markets to be this place where they are kind of designed for like the big venture bank investments to generate liquidity, and they do very little for anybody else. That's I think
well, and it's like right in line with what we were talking about, where like, hey, the biggest funds with the biggest LPs investing in the biggest companies, like those can yield great generational outcomes, chasing massive ambitions that wouldn't have been possible without that volume of capital, right? Like, I got into a little bit of a Twitter tiff with Brett Adcock, who's the CEO of Figure. I don't remember what my original tweet was, but his response was, if you want big, ambitious undertakings, you have to have massive funds. I don't necessarily disagree with that, right? Like, as you build these really big, massive, ambitious companies, like, it's super valuable to have these folks that can write big checks and do all this stuff. The problem is the long tail of the unicorn zombies that you get. It sounds like it's the same thing in secondary markets, where it's sort of, it's not a function of like, hey, like, and I have friends who will text me all the time and they'll be like, hey, like, should I, I've got this SPV or whatever into SpaceX, like, should I be paying 3 and 30 for at 250 billion for SpaceX or whatever? I don't know that I would do that. Not because I don't think that SpaceX can be bigger than 250 billion, but because I don't, like, financially, I just don't want to be paying fees to hold something that like probably will eventually go public, and then I can buy it as a public stock and like hold it for a long time. I think the psychological danger in that perspective is that people, like, they think like, oh, it's big, but it's going to get bigger and I don't want to miss out on that, which again is like the trader mentality rather than the long-term hold mentality. Like, it's like, I want to own good businesses for a long time. That's not how most people think. They think about the like, and I think crypto has probably poisoned a lot of people's perspective in this regard, where like they have a ton of friends who it's like, yeah, I bought this random meme coin, and it's like, I turned 20 grand into 2.5 million or whatever. And they're like, I got to get me some of that, And it's like, that level of volatility it's not sustainable. It's not safe. It's not the best way to think about capital allocation. But it's really hard to ignore when the game is on the field of people making that kind of money. But like probably like even if you do pay 3 and 30 for secondary and SpaceX at 250 billion, you'll probably be fine. Like maybe it's like it's not a great way to make money. Maybe the upside is not totally worth it because it's not going to go so much higher before they go public. I don't know. Like it's not the end of the world, right? The danger is, to your point, like once you get down the 30 into the 50th or 60th name, it's like, well, how much has that been vetted and how dangerous is that? And it's like, actually, there's a pretty solid probability that that company could be yet another of the sort of zombie unicorns on the trash heap of history. Like, so that I think is bad in terms of like the types of exposure that retail investors are getting. The other thing I wanted to ask you about is, so like, for retail investors, that's bad. The other thing that I think of as like one of the sort of cardinal sins of venture is the generation of lost potential, right? I wrote about this just last week of this idea of like building mighty small businesses rather than like, because people think they hear small business and they think, oh, like a mom and pop flower shop or whatever. And it's like, well, no, like the example that I use is this German company called ThinkCell that is like a plug-in to like Excel and PowerPoint. And the company was like 200 million of revenue and like 60% profit margins. So like and never raised money. So the founders were just like printing $100 million a year. Like that's crazy, right?
Nice.
In the outcomes that we're talking about of like these massive 20, 30, 50, $250 billion companies, that company got bought for like 2 or 3 billion, I think. Because like it wasn't growing super fast, whatever, right? It's super profitable. They can use that, invest in growth. Like it's a great PE buyout once the founders were done printing money. But like that, like in the world we're talking about, that's a small business, which is insane. Like that's crazy. But like there are so many great, amazing generational outcomes for the people involved that are poisoned by chasing the loudest models and everybody trying to be the thing. And so there's a ton of companies that could have been really great, interesting businesses, but that they got just totally rocked by trying to chase the loudest model. So it's almost like the lost generation of compelling technology companies that get kind of poisoned.
Yeah, and I think you've seen a number of investors try to get a handle on this. Like think about Calm. So he was trying to essentially invest in like smaller companies, lower on the risk return profile, and essentially, like from what I gather as a third party, I don't have any like proprietary information or whatever. Essentially, what caused him to give up on that plan was the difficulty of raising money from LPs, because they want the big flashy narrative about, we're gonna ride this incredible wave of technology and give you a 10x return, and we're perfectly positioned to do this because of whatever our background it is. They don't want the like boring by the numbers pitch. It doesn't work. Like it's way too much of a grind to go out and pitch that to everybody and try and raise a fund. So, and it's a similar problem if you're a fund and your focus is kind of like being a bit like, we're kind of nerdy, we focus on portfolio construction and discipline. That's great, and you could do really well, but you're going to have a really hard time raising money to do that. And raising money kind of became the aim of VC in the last decade or so.
Yeah, I mean, and I would ascribe that difficulty to the exact same phenomena where it's like, okay, company A raises a ton of money, way too much money. Like there's a ton of companies that I know that are, they're 20, 30, 40, 50 million of ARR, growing nicely, like growing like 60, 70%, whatever. But in 2021 or whatever, they raised at 1 or 2 or 3 billion when they went from 0 to 5, and they raised it $1 billion, whatever. And those companies, no matter how hard they work, it's very unlikely that they will ever get back to that price. And so no matter what, they're sort of stuck under this like really significant stack. And people can think like, oh, like you just build a nice small business or whatever. It's like, yeah, but like let's say you get bought for, you raised it at $2 billion valuation, and then it just didn't work out the way you wanted it to. You grow and grow and grow. The team works for years, for 5, 6, 7 years, and you get bought for $400 million. If you hadn't raised at $2 billion, a $400 million outcome is awesome. Like it can be life-changing money for the majority of people who work at that company. But when you're stuck under a 1x liquidation preference, you basically don't make money because you don't clear the pref stack. And that's hugely problematic for folks. But the same logic of like that company could have been a great company, but they were too focused on the loudest models. The LP who won't invest in Comfund because they're like, no, like, well, tell us how you're going to like ride the wave and have these big 10x outcomes and blah, blah, blah. That's the LP looking at the people who are deploying 250 million or, a pop and thinking that they want to play that game. And same thing with the venture fund that's saying, oh, we're taking these big swings and we're owning 3% of a Series A company at $1 billion valuation. but like it's going to be a generational company because of the revenue multiples or whatever. Like they're trying to play the Andreessen game. And one of my favorite, it's not my most popular piece, but it's my favorite piece because I thinking about it was super fun. But it's this idea of like playing different stupider games, like in parentheses. And like my point was that like, you know, people point to like Tiger during 2021 and it's like, oh, that was like they were playing a different game, but like turns out that was kind of a dumb game. But it's like, yeah, but like they were just playing it, they were just like taking a shot and they lost that shot or whatever. But like, you know, Andreessen doing what Andreessen does, or General Catalyst or whoever, like these big capital agglomerators, like that's not the dumber game. They're playing a very specific game. And to your point, they deserve credit for playing the game they play because they've got massive funds. They're breaking in hundreds of millions of dollars of fees every year. They can have huge teams. They can be super loud. And they're serving a very specific product to LPs who don't want 20% IRRs. They want 6% IRRs. And they're investing in companies that as long as they get, you know, a handful of these big, ambitious, you know, Ubers, OpenAIs, whatever, as long as they get into those, they don't care if 99% of their portfolio goes to zero because those few will generate enough to yield 6% IRR. And that's enough. That's fine. That's a different game. But anybody else who is the majority on a numbers basis, maybe on a dollars basis, but on a numbers basis, the majority of participants playing this game are not those people. They're not those companies. They're not those LPs. They're not those funds. And they look at this and they try and do that. And that's why stuff breaks. Like it would be fine if in a vacuum, this kind of big echelon of company building and capital allocation existed. The problem is that it kind of poisons the well.
Yeah, I think that's absolutely right. It's kind of why much of what I write about these days is aimed at clearly differentiating the two, because there are so many practices that emerged in the last decade because of these giant multi-stage funds that have been copied and emulated. Even like, you know, attitudes, like really like kind of like soft parts of the industry.
It feels like it's like blitz scaling and like move fast and break things and stuff like that. Like there are these hypotheses that people work on.
Yeah, and another one is this whole idea, which really bugs me. This could be like another one of the 7 sins. Like, I don't think people appreciate this enough. A lot of investors talk about fundraising as if it should be like a founder sales game, not an investor buyer game. The idea that success as a founder should hinge on how good you are at pitching to investors and raising money is insane to me. Your job is to run a company, to build a business, to, you know, change the world, build some incredibly disruptive technology, not to pitch to VCs. It's the VC's job. Go out and find you. To be like, oh, this guy who's so much of a nerd, he hasn't been able to raise money because nobody can understand what he's saying. Like, there's huge alpha in that opportunity. Like, that's what it should be about. How many VCs today who grew up in this environment who expect the, like, super charismatic Adam Newman type founder would have passed on Elon Musk because he wasn't charismatic enough in the pitch meeting? That kind of drives me crazy. But it's another example of like, this is very clearly behavior that if you're a smallish VC fund looking for great outlier returns, you should be thinking about this. Whereas if you're a venture bank, yeah, you want the Adam Newmans. You want the people who can pitch easily and raise money as fast as possible. That makes total sense. But understanding the two, and particularly educating LPs about the difference and what they should be looking for based on which category they fit into, is super important. And it's basically pretty much all I talk about at the moment.
It's super problematic, and it creates this like never-ending. SBF tweeted about like a couple years ago about the circle jerk of venture capital. I my mom reads my blog, and so I was too nervous to reference that, but so I called it the back scratch circle. And then like more holistically, it's like this value chain of capital. Like that, I think, is the biggest kiss of death for that dynamic that you're describing, because if you need to raise more and more and more money, like if you're trying to do something that requires a lot of money and you're not that, like you are that sort of non-consensus, not super charismatic founder or whatever, like I can't tell you the number of times that I've known someone who like I feel like is truly an exceptional founder. Like they're a very good operator, they're very thoughtful, but they need to raise capital. Like the model that they have is capital intensive, whatever. They need to raise capital and they just can't because they don't fit nicely into this value chain of capital. Like that is a problem because that non-consensus person could be a really great founder, but they don't fit into this ecosystem. The ecosystem is poisoned by sort of the noise. So yeah, I agree. And I think that's why Kari, the CEO of Linear, published a post last week, I think, where he talked about the profitable startup. And this idea of like, it's like once you're profitable and you don't have to worry about death, then you can focus on building the thing you want to build in the way you want to build for the people you want to build for. Like the freedom that you get from that. And like Linear is that kind of company. Like they've been profitable since day one. They've bought out a lot of their investors, right? Zapier was similar to that. Like they just kind of existed. Like you can build that company. The danger is, again, the stupider game is not realizing that you're playing that the person you're competing with is playing a very different game than you, in a way that you playing that game with them is going to be completely impossible for you to be successful at. Okay, so I think actually this is funny to me, but so I've been taking notes while we've been talking, and I think we actually literally landed exactly on 7. So we have the 7 deadly sins.
Nice.
So as a recap, and tell me if you disagree or think any of these, but I thought this was super interesting. So the first one we talked about was this sort of idea that I've called like allocators versus adventurers. I kind of molded that together with this like incremental outcomes versus ultimate outcomes, like people care about, and your point about like it's more about the trader mentality versus the investor mentality. All that kind of flows together is like the mentality shift is a huge problem, and I think it's systemic. The second sin it's like, caused by that is this platformization of venture, where it's sort of everybody expanding out, trying to cover as much ground as possible, extend themselves as much as possible for whatever reason, right? It might be justifying having a bigger fund to get more fees. It might be justifying having a bigger portfolio, whatever. But that platformization of venture forces people trying to be bigger, louder, more well-known. That pushes the agglomerator or venture bank agenda, where it's super pervasive, even though it doesn't translate into like the typical venture model. It's like the capital agglomerator sort of stuff is sin number 3, which then the poisoning the well dynamic of these are the loudest models that sort of break everything for everyone else. That's sin number 4. And breaking those models for everyone else, there is that element of like venture predation, where it's, and I think it's both on the company side, kind of sucking all the oxygen out of the room, and on the venture side of like using capital as a self-fulfilling prophecy.
I mean, particularly, I would say to like summary of why that I think it is a huge problem is it basically turns venture capital from a positive sum game of like creating innovation and great things in the world, turns it into more of a zero-sum game of like competition eating competition. And of the two, the first is clearly more desirable.
Mm-hmm, totally. Which is sin number 6, which is what we talked about, this sort of lost generation of potential companies. Comfund, Indie VC is another one that's awesome. Bryce Roberts.
Yep.
Like those there's a generation of companies that become these sort of zombie unicorns because they tried to fit into a model and it poisoned the well for everybody. That zero-sum game forced everyone to sort of, eat each other. And the result of that is that most people got eaten, right? Like you could have had a lot of companies that were great, and instead you have a few companies that are generational at the expense of a generation of companies that could have been great. And then finally, because of all this nonsense in the ecosystem, I will say, like, again, still, I always hesitate to blame founders because I feel like it's primarily the sins of venture capitalists. But the 7th sin is pointing the North Star metric at fundraising and saying, how much capital can we raise? That's an indication of how good we are. That's how charismatic we are and whatever. Like, it forces that behavior where it really forces you to get outside of your own head and get outside of, like, the consensus strategy in order to be like Kari at Linear and say, I don't care about the North Star metrics. Like I am good enough. I'm profitable. I want to build the way that I want to build. Zapier, right? Zapier was not a venture darling for years and years and years. Like when they raised that big secondary round from Sequoia to help provide liquidity for employees, still, as far as I know, none of that went to the balance sheet. Like that was all just, hey, how do we reward early employees for a decade plus of work? Like that company continues to exist to the, marching to the beat of its own drum. Like more companies could be like that if they are willing to throw off the sort of normativity of the industry.
I wonder how many cases there are. I know of a few, probably there's a lot more, but like as a percentage where a startup went out to raise a round or maybe 2 rounds because they were in that like valley of death at the beginning and they just needed to get the product built, get to market, build the team a bit. But then they found themselves on the treadmill and they get stuck because now the targets that they needed to give to raise the money, they can't quite get them without raising more money and more money and more money, because that then falls into the incentive patterns of the VCs themselves who want faster growth, bigger markups, all this stuff we're all very familiar with now. So, I know you didn't like pointing that one at the founders, and I'm kind of taking a cheap shot by turning around and taking the founders side back at you. But yeah, I think for sure there should be a bit more of a focus on founder education in general about fundraising. Very simple principles like you should not raise venture capital unless you absolutely have to. That's a basic one. That should be like rule number one. They should know that from the beginning. And there's a lot of things that founders should be taught. And the fact that they aren't is a failure on the part of a few different places you can point to, partly founders. But beyond that, I think there's a lot of the industry kind of taking advantage of how little founders know. And frankly, how little a lot of investors know as well.
Yeah. I mean, I'm going to stake to it, man. Like, I think that founders have very little blame because I feel like, and me and Bill Gurley had a back and forth on Twitter a couple of weeks ago where it's like, it's really hard. Like, it's really hard to say no to that, right? And like, literally there was like in the press, like played out in public example of this when Masa at SoftBank went to Uber and they had been negotiating investing in Uber back when it was still a fight. And he basically said like, hey, like if you're not going to take our money, we're going to go give it to Lyft. And it's like, we can't have that. Like, we don't want them to have this big war chest all of a sudden, right? Like, so we guess we have to take it, like it's really, really difficult for founders to say no to this ecosystem that exists. And it requires like an intense, especially because like you get abandoned to like, if you don't play the game, you get abandoned to this really difficult, dark world of company building that like you're still probably, 90% of startups fail. Guess what? That's still true, even if you raise a ton of money, but it's hard to acknowledge that like these things that feel like, oh, I'm making progress, it feels like you're de-risking. So you're going from 90% likelihood of failure to like 80, 70, 60, 50, whatever. Whereas like if you're linear and you're just slowly building a company over years and years and years, you don't have the same milestones to make you feel like, oh, we're being de-risked. It constantly feels like we have a high likelihood of death. And so you have to it's a total psychology shift to say, hey, what I care about is generating profit. What I care about is positive unit economics. What I care about is high NPS from my users. That's what I care about because that's what keeps me in business. Not raising money, not getting a ton of press, not being super loud, whatever, not hiring 300 people in a year. Like I care about this specific thing, but that's really hard. Like it's hard to do that.
Yeah, there's not a great deal of data about this out there, but I do know of one study of like 6,000 startups. I think it was maybe in Saudi Arabia, and they were looking at the relationship between funds raised and success. And it's like a U-shaped relationship, it turns out. As you raise money in the beginning, the chances of you being successful grow, but as you raise a crazy amount of money, that begins to fall again. So it kind of indicates that the recipe for success is to know how much you need to raise rather than just raise as much as you can. So then that kind of ties back to thinking about financial health and valuation, raising based on targets that are set by financial projections rather than just as much as you can. So yeah, it's just connects to that whole financial discipline piece.
Yeah. I love that. I think that's an awesome place to stop, man. Thank you so much for jamming with me and helping me kind of craft these 7 deadly sins of venture. I'm excited to publish this piece and keep jamming with you online.
I'm looking forward to it. You have a hard time shutting me up about this stuff, so anytime.